I am here with Andrew Bailey, who is the governor of the Bank of England, and just a little bit wet after walking on that walk. I can say it was actually really impressive. You guys seemed unfazed, but it just kept pouring on you.
I'm just keen to take some of the rain back to Britain, although I think it has started raining in Britain now. But yes, we could take some back. But you had no mountains today, I'm afraid.
No, they've been completely swallowed. And actually, Catherine Mann had the same approach. So maybe we could take some of this back to England. Just want to get your sense. What was your takeaway from Fed Chairman Kevin Warsh's speech? Was it something that was a message that you were hoping for, or that you thought was appropriate?
Well, look, first of all, obviously it's a cardinal rule that we don't comment on each other's monetary policy.
Okay.
But let me say, I think in the broad position that Chair Warsh took, I thought it was a speech of real substance. I think he made some very important points about the framework of monetary policy. I think he made very important points about forward guidance and how he's thinking about it. So I commend it because I think it was a real speech of real substance. He
talked about forward guidance as being somewhat antiquated to a moment that's much more complicated, and that it can be more confusing and complicate monetary policy and might have led to the 2021 delay in hiking rates to combat inflation. Do you agree? Do you think that forward guidance has outlived some of its purpose, including reaction function to some degree?
Well, I think we all wrestle with this issue. It's a really important issue. So the distinction I try to draw is this. Monetary policy, by its nature, is in the business of making policy forwards. We can't influence what inflation is going to be tomorrow. We can influence what inflation is going to be at points further into the future. So we have to obviously look to the future, and we have to describe our policy in terms of the future. But, and Chair Warsh made this point, there's always uncertainty. There's even greater uncertainty, I would say, at the moment, particularly about the immediate situation. There is always uncertainty, and therefore our decisions are always conditional. I think the problem with forward guidance, and I think Chair Warsh put his finger on this, is that it tends towards making unconditional statements about policy. And I think that's the problem, and I think that's the danger, and I agree with him. Whether it's out of date, good question. I think the 2021 point, to me, as a veteran of that period, is COVID was such a huge shock that we had to, in a sense, and look, there was a huge demand on us to sort of, in a sense, step forward and put the tools to work, and to do everything we could to put the tools to work. We're not in that world now. And I don't think, unconditional statements about policy work in that sense. But we have to describe, what we're doing in terms of, our views on the future, uncertain though they sometimes are.
It was notable to me that Chair Warsh talked about the components of PCE and that it was broad-based in the U.S. Is it as broad-based in the UK, or is it a different inflationary backdrop due to AI, the investment there, and some of the growth backdrop that's very different for the US and for the United Kingdom?
Well, there is a different growth story. Having said that, I think AI is critical here because we need to see faster growth in the UK. We need to see faster productivity growth, and I think AI and robotics are, a critical, source of that. I think the point that Chair Warsh made, which is very important, and I'll apply this to the UK, is he made a key point that, he is looking to see whether, I think he used the word trend inflation, but, underlying inflation is going back to target. And I think also over what period of time. And that's our issue as well. We are looking at the second round effects of the energy shocks. We're looking at the question, over what, do we expect inflation to return to target? Over what time? And is that time and that trend sustainable and consistent with the inflation target? Now, in the UK situation at the moment, I would say, so far, I think we're seeing quite subdued second round effects. I think we've seen a softening labour market for some time now. I think the second round effects are at the moment quite subdued. And that's why I've taken the view that I think we can watch this situation for the moment, but we have to, every meeting we have to come back to it.
How much does it force your hand if the Fed hikes interest rates, which right now the markets are expecting the Fed to do? Does it put pressure on you to match that in some capacity, partly because of the currency differentials, partly because of this race for capital, this competition for capital?
Well, I think Chair Warsh made the point, whatever the Fed does, it will do it based on its remit and its responsibilities in respect to the US, and it will do it for reasons to do with the US. We will have to take decisions to do with the UK. Now, of course, we have an open economy. We all have to see the effects of what goes on in the rest of the world on our situation and on our inflation outlook. But that's the way we do it. We don't say, well, they've done this, so we'll have to do it as well. We say, what's the overall impact of all of this on our inflation situation?
One thing that the U.S. hadn't had to deal with as much as you was a divided committee. It was normal to get unanimous after unanimous after unanimous decision, and then we would get the BOE's decisions, and it would be, 4 people voted for this, 3 people said they were nuts, 1 person said, why am I even here? And then there was a big brawl. I'm just wondering, from your perspective, is there any advice you'd give Chair Kevin Warsh about how to handle this sort of division that you get on the Central Bank Committee?
Absolutely. Well, no, I think, but let me say, I think each of us obviously takes our own approach towards chairing the committees. I think it's important that it is a plurality, first of all. I mean, the whole reason we have 9 members on the committee is to have a plurality, to have different views, to have deliberation, which is absolutely key to this process, that we sit in a room for more hours than we care to remember, and we deliberate and we reach a conclusion. Now, I think it's important that we are transparent about that. So we've made some innovations really following the work that Ben Bernanke did for us. For instance, we've introduced change to our sort of transparency in the sense of now having these paragraphs giving the individual views of each member. The monetary policy statement, though, is very clearly a view of the majority. I think that clarifies the sort of division of views. But my view in our setting is I think it's very important that we're transparent, and I encourage, as I say, this plurality to come out. And then I have to try and steer it to a conclusion.
Well, question for you. We were talking about how we're hearing from a lot of hawks. We heard from a lot of hawks today. Yeah. Your own colleague, Catherine Mann, she describes herself as on the hawky side. We heard from earlier this morning, Beth Hammack of the Cleveland Fed also talking about how it's just been too high for too long when it comes to inflation. Do you feel like you're in a minority saying, hold on a second, wait, we need to really watch this because we don't want to torpedo the economy before it has a chance to really right size? Well,
look, I don't characterize myself as a hawk or a dove. What I do think, and by the way, the majority of our committee is, has been in the same places. As I said, I think we are seeing, at the moment, relatively muted second round inflation effects. But obviously, this is an evolving situation. I can't give you any, and this comes back to the forward guidance point, I can't give you any promise that will continue. What I can do is our job is to get inflation back to target. We will do that. We will consider not only the path back, but as I say, how long that path takes, and is that consistent with price stability.
How complicated is the job of central bankers globally, particularly from developed markets, given how much debt has been incurred over a pretty low rate period for a number of decades? Does that create a difficult issue with accusations of politicization, given that what the Fed or the Bank of England does has a pretty direct ramification on the overall budget of different governments?
I think probably the most complicated area for that is balance sheet management. We have been reducing our balance sheets. We will have a decision in September. I'm not going to prejudge what that decision is, but my view is that it's important that we have a balance sheet that gives us scope to do whatever we need to do in the future. But it is important also that we reduce the interest rate risk on our balance sheet. So that's important. I think this debt question, I think you have to put into the broader context of the challenges that we all face, I think, in developed economies. And look, there are very sort of big long-run challenges. So I think aging populations is a big long-run challenge. I think the turnaround of the post-Cold War defense expenditure dividend, if you like, it's now gone obviously into reverse, is a very big challenge. And these are challenges, they're not direct challenges for monetary policy, but they are obviously challenges for economic policy, and they are having an impact on fiscal policy, and they are having an impact on debt levels. And if you look at the long-run projections, they tell you these are issues that we are going to have to seriously manage.
Well, it really is notable that normally this is much more attended by global central bankers, but a lot of people are distracted because they have to go to Asheville for the G20 meeting, which you're heading off to tomorrow morning. it's sort of notable at this moment. It's rare for this to happen, for this meeting to be so close to that meeting, both in location as well as in timing. But it sort of indicates the moment that we're in, and really this idea that the finance picture, the fiscal backdrop, can't be extricated as cleanly from monetary policy as it could be, say, 20 years ago.
We've got a slightly different cycle this year. I mean, normally we have the G20 meetings in February and July, whereas this year we're having it end of August. So that's caused the sort of look. In some ways, this works quite well because we're in the US. So here we are. So it cuts down on the extensive travel that we do. I wouldn't really interpret it any more strongly than that, really, in terms of the meetings.
Do you think that in the UK, just switching gears a bit, in the US, people are talking about AI being the holy grail of productivity? You were touching on this and saying that you hope that it would be the case. Do you see AI as being more disinflationary than inflationary in the United Kingdom? Do you see it sort of being inflationary in the short term to the same degree that it's being seen in the United States?
So I think the interesting question there is there will be both demand shocks and supply shocks from AI. I mean, if you look back in, economic historian in me always comes out at this point, I'm sorry. If you look back at general purpose technology innovations in the past, actually they don't have the same pattern, but in terms of the sequencing of shocks. If we get the demand shocks ahead of the supply shocks, then you will get pressure on inflation upwards. And of course, those can come through in terms of asset markets. If you get the supply shocks first, you'll get the opposite.